Raise your hand if this has happened to you. You finally start investing. You open the brokerage account, you research ETFs, you buy something that's supposed to pay dividends, and then you wait. Monday, nothing. Tuesday, nothing. A whole month passes, still nothing. And then 3 months later, you finally get the notification. Dividend received $4.17. That's when it hits you. Your bills show up every single month, but your investments barely do. And that's exactly the problem most investors run into. Because if your goal is to eventually live off your portfolio, or even just have your investments cover one real bill, quarterly dividends are painfully slow. So today, I'm going to show you 3 ETFs that actually pay you every single month, not every 3 months. Even better, all of them are trading for under $50 per share, which means you don't need a huge account to start building income. And stick around because the last ETF on this list is paying over 10% yield right now, and it holds some of the biggest AI and tech companies in the world. This one surprised me. Let's start with the ETF that might be the most underrated income fund in the market right now. My name is Finn, and I spend way too much time thinking about how regular people can actually build income from their portfolios without needing to already be rich. If you're someone who's frustrated watching your dividends trickle in once a quarter while your bills arrive every 30 days without fail, hit subscribe and give this a thumbs up if it helps. All right, let's get into it. ETF number 1, SPHD. First, let's talk about volatility because it's the thing nobody wants to admit scares them. We all love investing when the market is going up. The green arrows, the little confetti animations in the app, it's great. But when you open your portfolio on a random Wednesday morning and everything is red because of some geopolitical headline or a Fed comment that spooked traders, that feeling is genuinely awful. And the older you get, the more that feeling costs you, not just emotionally, but financially, because panic selling at the wrong moment is one of the most expensive mistakes an investor can make. Here's what most people don't realize. There's actually a fund built specifically to fight that problem. Meet SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. Now, the name sounds like financial jargon, but the actual strategy behind it is kind of brilliant once you see it. It starts with the S&P 500, the 500 biggest companies in America. Step 1, it filters that list down to the 75 companies with the highest dividend yields. Gone are the companies that make you feel smart but don't pay you anything. Sorry, Tesla. Sorry, Amazon. Step 2, and this is the part that matters, it takes those 75 high payers and ranks them by how volatile they've been over the last 12 months. Then it keeps only the 50 calmest, most boring, most predictable ones. What you're left with is essentially the most reliable income producers in the American stock market, companies like Altria, Verizon, Pfizer, and Kellogg's. Think about it. No matter what's happening in the economy, people are still paying phone bills, they're still filling prescriptions, they're still buying groceries. These aren't exciting businesses, but exciting is not what we're here for. Right now, SPHD is trading around $49 per share. The forward dividend yield sits at roughly 4.08%, and the expense ratio is just 0.30%, meaning for every $1,000 you put in, you're paying Invesco $3 a year to manage this entire strategy. That's less than a sandwich. Now, you might be thinking, Finn, 4% isn't exactly life-changing. And you're right, on its own, it's not. But SPHD isn't your high-yield play. SPHD is your anchor. It's what lets you sleep at night while the rest of the market is having a meltdown. On a $10,000 investment, you're looking at roughly $34 a month in passive income. That's your Netflix, your gym membership, your Spotify, covered automatically every single month without you touching anything. That's where it starts. ETF number 2, SDIV. Now, maybe $49 is still more than you want to spend per share. Maybe you're working with $100 or $500 and you want to feel like you're actually building something, not buying a fraction of a share and watching a tiny decimal number tick up. Here's where it gets really interesting. Meet SDIV, the Global X SuperDividend ETF. This fund has been around since 2011, so we've got over 15 years of real-world history to look at. It holds 100 of the highest-yielding dividend stocks on the planet, not just America, but Australia, Brazil, Hong Kong, across the globe, and right now it's trading at roughly $26 per share. The forward dividend yield, around 9% monthly. For $100, you can own almost 4 whole shares of SDIV, and every month those shares generate income. Turn on your DRIP, your dividend reinvestment plan, and every dividend buys you more shares, which pay more dividends, which buy more shares. The compounding starts almost immediately. Now, and I always keep it real with you guys, I need to give you the honest picture here, because SDIV is a specific kind of tool. Because this fund chases yield so aggressively, the share price itself doesn't typically appreciate the way a growth stock does. The price tends to stay flat over long periods, so if you're expecting SDIV to double in value, that's not what you're buying. You're buying the income stream. You're buying the monthly cash. Think of it like a dairy cow. You're not betting on it winning a race, you're collecting the milk every month. One more thing worth knowing, since SDIV invests globally, you're exposed to some currency risk. If the US dollar strengthens significantly, those foreign dividends can convert back to slightly less when they hit your account. It's a real risk, but for a 9% monthly yield accessible for $26 a share, many investors consider that a fair trade-off. Okay, let's talk about real estate, because I know a lot of you have thought about it. The idea of owning a rental property, collecting rent every month, building real wealth through real assets. It sounds great until you run the actual math. A down payment alone in most markets right now is $50,000 to $100,000. Then you've got the mortgage, property taxes, insurance, maintenance, and my personal favorite, the tenant calls you at 2 a.m. because the heat stopped working, and somehow that's your emergency. What if you could collect the real estate income without any of that? Meet SRET, the Global X SuperDividend REIT ETF. REITs, real estate investment trusts, are actually a fascinating legal structure. By law, they pay 0 corporate taxes, but in exchange, they have to distribute at least 90% of their taxable income directly to shareholders. That's you. SRET bundles together the 30 highest-yielding REITs in the world into one ticker. Right now, it's trading at around $22.80 per share, the most accessible pick on this entire list, with a yield of approximately 7.76% paid monthly. Think about that barrier to entry. To own a piece of real estate the traditional way, you might need 6 figures up front and a credit check and a 30-year commitment. To own SRET, you need $23 and a brokerage account. And unlike a house, if you need your money back for an emergency, you sell it in seconds. You cannot sell a kitchen in 3 seconds. Now, here's the one thing I want you to write down if you put SRET in a taxable brokerage account. REIT dividends are generally taxed as ordinary income, not at the lower qualified dividend rate. That means they're taxed at your regular income bracket. The solution? If you can, hold SRET inside a Roth IRA. Inside a Roth, those dividends grow and come out completely tax-free. The taxman literally cannot touch it. If it's in a regular brokerage account, just set aside a small piece of each dividend for tax season and don't get caught off guard. So, how do you actually put this together? Because the worst thing you can do is just throw everything at the highest yield and hope for the best. Here's how I'd think about building a monthly income portfolio with $1,000 right now. 50% into SPHD. This is your foundation, your anchor, the thing that keeps you stable when everything else gets noisy. 25% into JEPQ. This is your performance engine, the tech exposure and the high yield that lifts your overall income significantly. 25% split between SDIV and SRET. This gives you global diversification and real estate exposure, so you're not entirely dependent on one sector or one economy. The goal here isn't to get rich by next Tuesday. The goal is to build a portfolio that pays you consistently, reliably, monthly, so that over time, your investments start covering real things: a bill, a subscription, eventually a car payment, eventually more. Stop waiting on quarterly dividends to show up like a distant relative who only calls on holidays. Your electric company isn't waiting. Your landlord isn't waiting. Your bills aren't waiting. And with the right ETFs, your income doesn't have to wait either. I want to know, are you team safe with SPHD, or are you going after that 10% with JEPQ? Drop it in the comments below. I read every single one. If this helped you, hit subscribe and give it a thumbs up. It genuinely helps this channel reach more people who need to hear this. And I'll see you in the next one.